the three different types of liquidity that I focus on, and the three that I believe are the most important to be aware of, is going to be trendline liquidity, support and resistance, which I would also classify as a range in some cases, and then equal lows and equal highs, otherwise known as double tops and double bottoms. So if we start on a trendline liquidity, we're going to be looking at this as an upsloping trend line for our example. So traders are taught to buy at a trend line or wait for the breakout to go short, and then vice versa when looking at a downsloping trend line. So as you can imagine, this creates lots of liquidity at these areas that the market will usually manipulate to grab liquidity before a larger move can take place. So if we jump onto Euro USD, we're going to be looking at a down sloping trend line, for example. So you can see we're clearly bearish, putting in these lower lows and lower highs. We have one tap, two tap, and then a third tap of this trend line. And note how the wicks are meeting perfectly. Now this isn't really a coincidence because, you know, people with large pools of money or large institutions, they know that retail are looking for these sort of patterns, so they're going to manipulate it so they entice them into the market. Now if we look at this third tap of the trend line, you can see we had a nice reaction, a retrace candle, so this gives us all the signs for entering. So this is what traders are doing, so they're looking at trading this to continue with this trend. Stop loss likely going to be above this high, which is also above the trend line. So this is the trade. So let's see how it plays out. So we get a nice push off. So we're in a bit of profit. Now it's not likely that you're going to move to break even. Some traders might, but we didn't. We barely met 1%. And then you can see price is now reversed, and we've broken the trend line, and we've broken above this high here. So this is essentially taking that liquidity from the sellers who was in this trade here. But what we also have with this is the breakout traders. So the traders that are looking at this as a break of trend line, break of this high, they have stop losses, buy stops. So buy stop orders above the trend line. So something like this, and they're probably looking to target, you know, the 90%, as people like to say, of this descending sort of channel. So, you know, they get triggered in to the buy stops. So they're expecting that move to the upside. So what's likely going to happen? Well, price pushes up, bit of profit, and then we range. So this is building liquidity. We do also have equal highs, but then you see price comes down, and eventually it puts in that new low. So what we've done here, we've taken liquidity from sellers and we've taken liquidity from buyers. So now that we've taken liquidity and we've got the fuel to actually move the market, that's what's going to happen next. So we can now see a move, you know, in one direction, which is what we got here. So you can see price then commits to one direction because it now can, because we've taken liquidity from, you know, buyers and sellers. So this happens, you know, all the time, and it's about just understanding why price is doing it. This needs to happen in order for price to move. Liquidity needs to be, you know, swept for a larger move to happen. So if we just go back onto this diagram, we're going to look at the second type of liquidity, which is going to be support and resistance. So in my opinion, this can also be classed as a range in some cases. So again, traders are taught to buy at support. So if we look at this diagram here, we have, you know, price come down, up, up. So it is a range, but this is also a form of, you know, some resistance and some support, because you can see price has respected once, twice, 3 times. Okay, so we have buyers down here and traders looking to sell up here. So again, this generates large amounts of liquidity above resistance and below support. So unlike us as average traders, we can buy and sell at any price at any time we really want, and that's due to the fact of our position sizes. But this is not the case for large banks and large institutions who have huge amounts of money. They need a reason to buy and sell. So what that means is they can't just open positions whenever they really want. They need to buy from someone who is selling or sell to someone who is buying. So if you were going into a store and looking to buy something but no one was selling, then you can't buy. So the same concepts apply to what we're looking at here. So if so many of these traders are buying at support, that then means that the large banks can't also be buying from them areas. This is why we see these areas in the market manipulated, which gives the market fuel to move. So what we usually see from this so-called support is we will see a grab of liquidity before price then reverses, then taking liquidity from this resistance or buy side liquidity before then reversing again. So it's not uncommon to see that on the charts. It happens all the time. So now back on the charts, we're going to put the trendline liquidity and support and resistance together and show you how it's manipulated. So again, you can see we have an up sloping trend line. So we get essentially 1, 2, 3, 4, which is, perfectly meeting with the trend line, as you can see. So we have, firstly, we have 1, 2, maybe buyers are getting involved here, but there's definitely going to be buyers getting involved, as we tap here, nice retrace candle, stop losses below this low, and looking for them higher prices. So granted, price does come up. We form equal highs at this area. Price then reverses. So, maybe some break evens being taken here. But then again, price didn't really break any structure or any highs. So then price comes back down, takes liquidity from anyone that's in these buys from here. So if we have buyers that got involved here, it's likely that they're going to be, if they're holding their trade, that they're going to be managing their trade at the lows, because as we know that there is liquidity at every high and low in the market, which price tries to move to in order to get that liquidity needed. So this is what's happening here. So we push down, breaking these lows here. Price then comes back up, and also for anyone who sees this as a break of trend line, as you can see, we wick it here, we pull back, we break structure, and we break this trend line. So we have sell stop traders or people with the break and retest looking at this to get involved short. Price then comes back up, we form equal highs, also known as resistance. So we have sellers getting involved here, and then price pushes off, it then pushes up. So this here is nothing more than a liquidity sweep of these highs for anyone who's in sells, or anyone who's trading this as a breakout of resistance, something like this. They're looking to go long after this nice break. So then what's likely to happen? Well, we've taken liquidity, and then you can see how the next two candles are, huge momentum, which, these two candles is the same size as this whole sort of range here, because price now has a reason to move. we've taken liquidity, price can now move and commit in one direction. But as that's been said, we do have a push down to this low here. We have equal lows, and let's see what happens next. Okay, so we push below that low, and then we do push back up, which was likely, a reaction from an area looking left. But what can you also notice about this reverse in price here? Well, we have equal lows here. Let me just delete this trend line off. So this is equal lows. So you can see how we have one low, price then come back to it. So it's a double bottom, but we know it as equal lows. So we know there's liquidity at this area below it. So price wicks it here, which is just grabbing liquidity. And then we can see price reverse and break above these highs here. So this is what's happening on the charts day in, day out. This needs to happen in order for the markets to move. So you can see that anyone that thinks that this is just coincidence, how price comes down to this low at the candle bodies, we then wick it below before a nice move in the other direction. So it's not coincidence, it's happening. We see 1, 2, 3. So a clear level of resistance or equal highs as we know it. Price then comes up above it. Anyone selling or already sold from here, taking liquidity, huge momentum down, sell side liquidity, wick, reverse. It's happening every single day, and the more you sort of go and back test this and understand that this happens all the time, the better you'll be able to see it and basically be on the correct side of the market and not trade any of this support and resistance sort of nonsense, because that's what it is really. So if we look at this next example on dollar Swiss of equal highs, we can see previously we had these series of lower lows and lower highs. So we broke structure here, price pulled back to mitigate, breaking structure, price pull back to rebalance this inefficiency, breaking structure. And what we can do on lower time frames from here is refine this down. So what we can see is we have this 1 hour wick, which I've marked off with this zone. So as we've learned already, a wick is just a area of interest on a lower time frame. So this wick on a 15-minute would be like an order block or a supply zone where we can short from. But if we zoom in, we can see we're continuing to stay below the lower highs. So we're breaking structure. Now we push up and we actually break above this structure here. But as we've discussed already, it's about how it breaks and what is it showing us as it's breaking. So we can see we've got a calm and sort of corrective break, which is mitigating this wick, as we know on a lower time frame, to be an order block. So this is about how, reading price and what is it telling me. So we can see it's not any momentum in the break. We have one candle, but we're not breaking with momentum. This is just taking liquidity from these equal highs. So as you can see, we have a high and a high. So this is an equal high. Price comes above, taking liquidity from anyone who's in short, who's trailing stop losses or getting short from, wherever they're getting short from. There is a lot of traders in this market. So this is just seeking liquidity. And then you can see, now that we've done that, we can then see momentum in that direction. So once we break structure here, we're still bearish because we're looking to see how it breaks and what it's tapping into, and we can see it's an hourly wick. So if I go down to a 15, you can see them equal highs clearly. People looking to short from these areas here. Nice retrace, price taps up. And then you can see that's that order block. That's the wick on the hourly. price broke structure, as you can see here, and that's the last up candle before the down move that broke structure. So you can see we have entries in here that we can take advantage of on a lower time frame, but this is just showcasing, you know, when the market has shifted and when it hasn't shifted, and we can identify that by looking at price action and seeing how price is breaking structure and what it's tapping into when we look left.